Okay, hi everyone. Week 4, depreciation. A fairly straightforward session today. We should be able to knock this over in, I'm hoping, around about 20 minutes. So let's do that. Depreciation, one chapter this week. And one of the things I'd encourage you to do, and sorry about this, I've just got to flick back through, not too many slides to walk through, just a handful really. One of the things I would encourage you to do as we come to these calculations, we'll be looking at prime cost or straight line method, also looking at the diminishing value or reducing method, and then calculating depreciation rates using the units of production or units of use method. Doing a couple of depreciation schedules. Excel lends itself to producing our depreciation worksheets and calculating the book value or carrying value of the asset that would be shown on the balance sheet. So here we go. A couple of examples here where we've got a range of assets. The first couple, she buys a station wagon for $15,000, but it's only used for 70% of the time producing assessable income. So she can only claim 70% of the depreciation amount. So we'll take 70% of the opening balance. We're going to put that in a depreciation pool down the bottom in a moment. Computer, same sort of deal, $3,000. It's 70% used for business, for producing assessable income for the business. So she can only claim 70% of the value of the depreciation. So let's take 70% and put that in the pool as well. But this time a refrigerator, $1,500, used 100% of the time for business. So we can use the full $1,500. So the opening balance of the pool, grab the three values, add them together, $14,100, and the depreciation for the first year then in this particular general pool, the rate we were given was 30%. So the depreciation for that year, for that pool, $4,230. The rules keep changing from year to year, so that was fairly old back in 2015, 2016. Look, there is a simpler depreciation for small business available, and it enables an instant asset write-off for assets. Again, we could only write off that percentage of the asset that was used in generating assessable income. Also, in relation to that, the threshold amount of the assets moved up from to 150,000. It used to be 30,000, and also the turnover to qualify as a small business. The turnover, as long as it's less than, turnover means total sales. If your sales are less than 500 million, you classify, you fit into the category, and you can apply these depreciation rules. It's up from $50 million. So tax rules in a whole lot of areas are changing all the time, and you've just got to keep up to date with the latest as we go. And so here, that is that first example then shown in a little table, if you like. Again, lends itself to a spreadsheet. We get the value of the assets. We'll work out what percentage are we using for tax purposes, apply those percentages. There's the amount that we can add to the pool, and we're writing it. We could write a little formula to calculate depreciation that we could claim. A couple of other methods that we'll look at is the prime cost method or straight line method, and we'll also then be looking at diminishing value method or reducing balance method. Same thing there. So you can choose which method you would like to apply as long as you're consistent. Once you've made that choice, stick with it. So the Australian Tax Office has set up estimated what they feel is fair effective life. So a computer are able to use that value there, an effective life of 4 years, a desktop computer, laptop less, 3 years, and a range of different assets here and their effective life that we're able to use in our formulas for calculating depreciation. So for prime cost or our straight line method, we just pick up the formula, the assets cost, times, if we've had it for a full year, obviously we'll be 365 over 365. We'll claim 100% the full depreciation for the year. But if we've only had it for half a year then, or however many days we've held it, divide by 365. That'll give us the correct, for the very first year that we've held it. Or if we've sold it halfway through the year, we can claim only that, obviously that proportion for which we've owned the asset, multiply by 100% over whatever that asset's effective life is given in that previous table. Got to watch out for the leap year, but the nice thing is that there is a nice little days formula in Excel, which you key in the date, the start date, and the financial year end date, and it can calculate the number of days for you. So let's put some data in there, see if we can make it work. So Wendy buys a photocopier for $1,500. She does that on the 8th of August, and we're doing it for the financial year end, 30th of June, the following year, 2013. So we could use that days formula I talked about in Excel. We'll do that in our workshop, but it looks like it's 327 days. And so we'll get the value of the asset, $1,500, multiplied by the number of days she's held it over 365, multiplied by 100%. And we look up the effective life, which from that table was 5 years for a photocopier. And we get the depreciation charge for that year, $269. In calculating the book value or carrying amount, basically we'll just be picking up the original cost of the asset, less the depreciation, and we'll get the closing balance, if you like, that will sit on the balance sheet. And for the following year, the next year, we've had it for a full year. So we pick up the value of the, so if we were doing it, it's 2016, yep. So had it for the full year, and we'll take that 100% over the asset's effective life, and we will get our $1,500. So we pick up the opening balance, less depreciation for this period, will give me the closing written down value. With diminishing value or reducing balance method, this is getting a little bit old now. If you bought it, the asset prior to the 10th of May 2006, you used this formula, the opening value over the asset's effective life times the number of days you've held it over 365, and you could multiply by a factor of 1.5. So you've got a little bit of extra depreciation above the stated value and prime cost. Excuse me. For after the 10th of May, you were able to get this factor of 2. Same formula, everything is the same. Opening value divided by assets effective life times the days held over 365, and you could multiply by 2. This formula, both those formulas are still valid, but we'd obviously, this is getting old now, and it will eventually disappear off the radar, and this will be the applicable formula. You can find that, chase that up if you wanted to. There's the little guide to depreciation of assets 2020 from the Australian Tax Office. Note that just dealing with depreciation is 46 pages. But not to be outdone, the CPA's guide to valuation and depreciation is 291 pages. Guide to Valuation and Depreciation by David Edgerton. So you could look that up and have some fun, a bit of bedtime reading for you. And there's the 2 formulas again. That's cool. Let's move on. So that is straight from the ATO's guide. Here we are putting some more figures in. It looks like we bought a desktop computer. We look up the table, we find out it's got an effective life of 4 years. So we pick up the opening value, divide by the effective life, and work out when we bought it, 10th of January 2006, calculate the number of days to the financial year end, 30th of June 2006 for this particular event, and multiply by 1.5 because we bought it before 10th of May 2006. But and then we just carry that balance forward. So if the 6,000 minus the 1,060 brings us back to 4,090 for the following year is the opening balance to then do the next year's depreciation, 4,940 divided by 4 over, and it looks like it was a leap year, 366 divided by 366 multiplied by 1.5. And we've got 1,852, obviously slightly more than that first year's depreciation because we've had it for the full year. But when we see it together in the schedule, really diminishing value or reducing balance method, if you like, it's not straight line. It's not like a fixed lump sum amount per year. We'll see that it drops. What the tax office is suggesting is it makes sense that an asset will lose more of its value and depreciate more quickly earlier on in its life. And so we're allowed to claim a larger amount early on in the life, which probably more accurately reflects its market value. But eventually we'd get down to small amounts and be able to write it off, save ourselves some hassle there. But for our questions, we'll just complete the schedule. And again, Excel allows us, once we've written the formulas, we're happy with it for the first row or the second row, we can drag it down and we'll get the results we need. This time, the asset was bought after the 10th of May 2006, so we'll be using the second formula. We're multiplying by this factor of 2. Pick up the opening assets values, look up and find out, well, what is it? It's a car. It's got an effective life of 8 years. So we plug the data in, work out how long we've had it to the end of the 30th of June, 232 days, divide by 365, multiply by 2. And we've got the depreciation for that first period. For the second year, opening balance minus depreciation for that year will give us the new balance to bring forward, 18,084 divided by 8. Got it for a full year, multiply by 2. So you might want to pause and just practice making sure your clerical accuracy is okay. Make sure you can push these buttons and get these results. If you can, you're looking good. Last method, units of production method, or units of use method. The more you use it, the assumption here is that the faster it will depreciate. So we could use kilometres, and any type of asset that has a serial number like a photocopier or a printer, it's pretty easy to work out how hard you are using it. So it's the cost over its effective life, but this time not in terms of time, but in terms of our use or output from the asset. So here we've got a laser printer. We've been told it's got an effective life of 10,000 pages. So the value of the asset over its useful life. So the rate of depreciation will be 27.5 cents per page. So that's our application rate. And then it says, okay, what's the depreciation, or calculate the book value if after it's printed 3,600 pages. So depreciation at that point would be 3,600 pages at that 27.5 cents. Gives us $990. Pick up the value of the asset, original cost minus depreciation. There would be its carrying amount or book value. Very, very similar, just an example here, but we're converting it now to effective life in days. So we've got hours, and we've got the value of the assets, $1,800. And it says, what if we used it for 10 hours a day? How long is its effective life in days? So all we've got to do is convert our hours to days. 8,000 hours divided by 10 hours per day will give us 800 days effective life. What if we're going to use the units of production method, and we're going to use a rate of depreciation per hour? What's its book value after 5,000 hours of use? So if we decided to run with hours, 1,800 divided by the 8,000 hours is 22.5 cents per hour. So for this floodlight, after 5,000 hours, what would its book value be? 5,000 at the depreciation rate, 0.225. there's my total depreciation, 1125. Pick up my opening balance, $1,800 minus my 1125. $675 would be my carrying amount or my book value. So Excel can do there is a straight line formula built into Excel for us. So we would just go up into the formula bar. We'll do this when we get together in class. Go up to the formula bar, hit the function key, look for the SLN function formula. Again, click on the FX key. It'll bring up this window, enable us to key in the cost, the salvage, and the life, and hit OK, and it will calculate depreciation for us. So here we are entering data from a question we did earlier. 7,500 salvage value is nil. We're writing it off over 5 years, $1,500. It's the depreciation. There is no built-in formula for the diminishing value, but we could just write a nice little template, which we'll do in class, which will calculate the amount of depreciation. So we'll do that in our workshop session. So I hope you haven't felt I've rushed that. And as I said, at any point, you could just pause and have a play and just make sure you're okay. But fairly straightforward this week. So look forward to catching up with you very soon.